After 20 plus years in the mortgage industry, I want to talk about the single most expensive mistake that I see buyers make. And let me tell you, it is not choosing the wrong house. It's choosing the wrong loan structure. So what I want to do in today's video is at the end of this video, I want to make sure that you understand mortgage discount points in a way that your lender probably never explained to you. So that way you can understand when it makes sense to choose to buy down the interest rate and when it doesn't, and how you can figure that out on your own if your lender is not doing it for you. So first thing we need to do is we need to define what the idea of discount points are and what it is that they're doing for you. So discount points are essentially prepaid interest you pay in the upfront period in order to secure yourself a lower rate in the long term. So in short, let's show it on the screen here. If you have a $500,000 loan and you pay 1 point, that's 1% of your loan amount, or in other words, that's $5,000. Now, if your lender is telling you that you need to potentially pay 2 points to get a specific interest rate, you would do that same math at 2%. Now we're talking about $10,000. Okay, so that's money that you pay up front in order to secure that lower rate in the long term. And what happens with a lot of these lenders, whether they be the ones that show up in your mailbox with really low interest rates, people who are text messaging you, people who work in a call center, any of those kinds of things, typically what they're doing is they're putting a really shiny object in front of your face. And that shiny object is a really low interest rate. And then you get down the path a little bit, and then they kind of lay it on you that, by the way, there are points involved to get this interest rate. They understand that the psychology of most buyers are around the idea of interest rate and payment, not so much cost, and they'll just kind of glance over that upfront cost later. And that can be a really, really expensive mistake. So let me show you an example of how that can be true. So this is that same $500,000 loan amount that we were just talking about. Let me make my head a little bit smaller. That same $500,000 loan amount that we were just talking about. Now you may go down to your local lender and they're quoting you an interest rate of 6.5%. But then some text message lender or call center or something you found online shows an interest rate of 5.75. Now you're going to be thinking to yourself, of course, I would rather take the 5.75. It's cheaper. But the devil's in the details. So when we factor in those two different interest rates, that of course equates to two different payments. In this example, a 6.5% interest rate is a payment of $31.60 a month. 5.75 is a payment of $29.17 a month. In other words, that's about a $242 a month difference in your payment. So all else equal, of course, you would want the 5.75, not the 6.5. However, we have to think about the break-even period. So in this example, we're doing a purchase price of $527 with 5% down, essentially $27,000. That's going to get us to a loan amount of $500. But the difference you would need to come to closing with, in this example, the only money you're coming into the table with is your down payment because there's no points. In this example, you're coming to the table with the $27,000 down payment plus an additional $11,000 up front for a total of $38,000. So in other words, you're paying an extra $11,000 in this example in order to get a payment savings of $242 a month. Now, I'm not saying this is a good thing or a bad thing, but what I am saying is you need to sit down and ask yourself, is this a good investment? Right? And there's a couple of things that you need to ask yourself. First of which is, when is the break-even period? Right? So we'll just take out a calculator and say, I'm going to pay $11,000 up front. And in exchange for that $11,000 a month, I'm going to save, in other words, I'm going to divide $242.48 a month. It's going to take me 45 months in order to catch up to the $11,000 that I paid up front. I'm going to save $242 a month, and that's going to eventually catch up to the $11,000 I paid. So after 45 months, I've now come out ahead, right? But up until that point, that money has not yet returned on that investment. Okay, so there's a couple of questions you have to ask yourself, right? When do they make sense? The idea points make sense when you are going to both stay in the home and you're going to stay in that loan past the break even period. So in this example we've been showing, it's 45 months. Will I be in this home for 45 months? Will I be in this loan for 45 months? If the answer is yes, then in that scenario, I would be well suited to pay the 11,000 up front in order to get this lower interest rate. If the answer is no, I'm only going to be here 3 years, or no, I think I'm going to have an opportunity to refinance in that same period because interest rates may come down, then I'm not going to want to spend that money up front, right? So some of it is pure math, right? Just divide the numbers into each other. But some of it is subjective, right? Like, how long will I be here? And what's my view of what the economy is going to do going forward? What's the, is there a likelihood that a lower interest rate will present itself as an opportunity for me to refinance into within those 45 months that I can take advantage of? Nobody can say with an absolute crystal ball, but you typically are going to want to work with a lender that has a really good grasp on what the future holds, what the trends look like, etc., to give you good advice. But if you get no advice, then you need to make that decision kind of on your own. The other thing that I would say you need to factor in is whether or not that $11,000 makes a difference to your liquidity up front, right? This is kind of a subjective thing, but having an 11,000 extra dollars in the bank can do a lot for you, right? You can, if you need to do some upgrades to the house, if you need to paint the house, if you need new flooring, if you need furniture, if you just need a shit happens fund, right? Like God forbid the water heater go out and you don't have a home warranty or something, like having 11,000 extra dollars in the bank can really make a difference psychologically for people, right? And again, you want to just think about what the likelihood is of a potential refinance, so you can see whether or not, maybe 2 years from now, you can get the 5.75 that you wanted down here, but you could get it without paying any points whatsoever. And that's an opportunity for you to potentially take advantage of that. So you're going to want to think through that. So my recommendation to use, if you're working with a lender, especially if it's one you found just randomly on the internet or went on one of those rate aggregation websites that show you like 10 different lenders at once, ask your lender to show you a comparison. Show me the same loan with points and without points, along with the calculated break-even period for any of those options, right? And if they won't do that, or if they don't know what you're talking about, that is a massive, massive red flag in my view. A really good mortgage advisor is going to run that math for you before you've signed anything for sure, but also before you have really made a choice around what that looks like. For example, in this example, I'm showing this client a 5-year window, right? What are my savings over 5 years? The lower interest rate saves you $5,065 over 5 years, right? And why is that? Because after month 45, months 46 through 60, you're saving that $242 a month, and that's going to end up saving you money over time. If you look at, we take it out even further and go 15 years, you can see this number gets even bigger, right? This is how much interest you'd pay on 6.5% over a 15-year period versus a 5.75% over a 15-year period. Even factoring in the $11,000 you paid up front, you're still coming out, essentially $50,000 ahead by buying the rate down when you're there for 15 years. So again, it's not that there's a right answer or a wrong answer that I can just give you, but you really have to think it through for your specific situation as to whether or not it makes sense. So if you are thinking about buying or refinancing a loan anywhere in the country and you want to talk with someone who actually will help you and advise you along making a decision, this is the kind of conversation I have with every client before we go into any loan structure whatsoever. So all my links are right there in the description. And if this helped you, feel free to subscribe. I break down mortgage stuff every single week, and appreciate you watching.